What is up, everybody? Welcome back to another episode of Bitcoin and Markets. Hope you guys are doing well on this Wednesday and hopefully ETF approval week. Today is January 3rd, 2024, and I was talking on Telegram a little bit earlier. I'm already used to 2024. This is going to be a big year, huge year for Bitcoin, huge year for macro. So what I wanted to do today was go through the Bitcoin dip this morning, talk a little bit about the chart. Then I have this video from Maverick. Let me get the name of the channel here. Sorry. Maverick of Wall Street is the name of the channel. And we're going to watch through one of his latest videos that came out yesterday. And I think it's a good learning experience. My macro style is very out of consensus. My even Bitcoin calls are, well, they're in directionally the same as what most people, the inflationistas, think about Bitcoin, but I have different reasons. And so I have different ways of understanding macro. And this Maverick of Wall Street, he is very, I would say, confused about what happened in 2023. At the very beginning, he says, who had that on their bingo card? Nobody. Well, I had it on my bingo card. So, he's confused about 2023, and now they're trying to forecast into 2024, and it's just that it's cannon fire, just buckshot out there. There's nothing that they're aiming at. There's nothing to keep them on the straight and narrow, where I have a significant macro thesis that has been extremely accurate over the last few years. So we're going to walk through that. So that's what I have on deck for today. Let me share my screen. Bitcoinandmarkets.com. That's my home base for all of my content. You can see the latest posts were the fundamentals report on Monday, as well as the January price forecast competition. So if you're a paid member of the website, you can put in a guess at the beginning of the month, the first few days of the month, and the person closest to the candle close at the end of the month, they win $20 in sats. So check that out. It's a fun way to maybe earn a little bit back from your subscription, but also join a community and have fun testing your knowledge and what you think about the next month for Bitcoin. All right, let's go into the charts. My computer is running a little bit slow here right now, so if we freeze, that is why. Okay, so the price did come down drastically from some FUD from a Jihan Wu outfit. What's the name? Matrix Port or something like that. And they had two blog posts yesterday or overnight. One was positive for Bitcoin and one was negative. Now, the reason why I say Jihan Wu is an enemy of Bitcoin is because he was a big promoter of the block size wars. If you go back to 2016, 2017, he was running what was it, Bitmain at the time. I think he's been out of Bitmain now, but he was running Bitmain. He's still around, still a big blocker, still attacks Bitcoin. There is some big blockers that are rolling into ordinals, and so a lot of people are thinking ordinals are just an extension of the big block attack. Jihan Wu is still around, fudding on Bitcoin. Anyway, so that is what happened overnight. This article that said, they expect all of the ETFs to get rejected, had a massive sell-off, about 8 to 10%, depending on where you measure it from. And it has really failed to bounce so far. And this is the most surprising part to me. I thought that if it had this FUD this close to the ETF approval, it should be recovered at least most of the way already. Of course, that can happen very quickly, but that makes me start to question a little bit if the ETF is actually going to get approved. And I talked about this on Monday on the fundamentals report. Old timers like me, we've been around for a while. We've experienced all of the ETF denials in the past. And my anxiety level going into this approval is actually increasing. I watched a video this morning from somebody on Twitter just put out a video, and they're saying that this news, even though nothing fundamental changed, it has decreased the probability of an approval from 95% down to 90%. And on the newsletter, I was saying, hey, it's almost feels like with my anxiety level, it almost feels like a 50-50 chance now. And now we can see this with a lack of a bounce. Maybe the rest of the market is starting to think that too. I do think that the ETFs will be approved. I have a good tweet here. Let me bring this up. I shared it with Telegram earlier. Sorry, let me just pull this up. And make sure that's going out. Okay, so this is Meta Lawman. He's been around a long time talking about Bitcoin and other things, but I mean, I don't follow him that closely, but I know that I've run across him before. If the SEC were to deny all spot Bitcoin ETFs, the applicants would immediately sue, and the DC Court of Appeals would again rule that the SEC was arbitrary and capricious. The SEC gave every reason they had for denying Grayscale and lost. I expect multiple approvals on January 10th. I also shared one of my just random thoughts this morning. The window actually opens on Friday. I was thinking that it opened on Saturday, but I was corrected by DT in Telegram. The window opens on Friday, so we could have an approval on Friday and then a launch next week, early next week. It could be a fast turnaround. Remember, the Ethereum ETFs did that. Quick turnaround. The reasoning is a little bit different. That time it was due to the debt ceiling coming out, or the debt ceiling being hit. We don't have that problem right now, but it does feel similar, where there's a possibility that we have a very fast turnaround, approval on Friday, and launch on, say, Tuesday or Wednesday next week. That would be Wednesday, would be January 10th. So that's all the stuff I'm watching for the ETFs. That's the charts. That's what I'm thinking. Long term, none of this really affects the overall trajectory of Bitcoin. Long term, Bitcoin is going up. 2024 is probably going to be the biggest year in Bitcoin history since the launch. And yeah, so I'm very, very excited for what's coming up. Okay, now I'm going to go to the main part of the show. There we go. So this is, like I said, Maverick of Wall Street. I am going to speed it up slightly here because he's kind of a slow talker, and it's an hour and 20. I'm not going to go through the whole thing, but I wanted to cover the first at least probably 20, 30 minutes just to get an idea of the confusion of these people. They didn't get 2023, and now they're going to forecast 2024, and they're just buckshotting everywhere, and they don't know. They're just going to throw everything out, see what sticks. They don't know what's going on. So I'm going to try to explain it as well as I can. Let's go.
Oh, right. Today is Monday, the 1st of January. Happy New Year. What happened to 2023? Who cares? It's gone now. This is a recap for the stock market activities last week and an outlook for the week to come, but it's also a discussion for 24. We're going to talk about the elections. We're going to talk about the Fed policy, the scenarios for the economy and the market, yada, yada, yada. Now, folks, I got a good one for you tonight, so stick with us here. Grab an adult beverage, whatever you need, popcorn, and stay still. And again, whether you went crazy last night with the partying and you caught herpes, or you decided to stay at home, keep it low, and just stay at the couch, order some pizza, get drunk, get stoned, get shit-faced, and then pass out and wake up the next year. Of course, with the latter scenario, there are no consequences. You just wake up, okay, it's a new year. With the former scenario, well, you woke up with a little gift, New Year's gift that will remind you of that night. Over and over and over again. So Happy New Year. In either case, doesn't matter to me. What matters to me is what a year was, 2023. Lots of surprises, defying expectations. A lot of crazy things happened when you look at the economy and the performance of the market, for example. We had the AI mania. We had collapse of regional banks. Major global banks such as Credit Suisse collapsed. Changes in Fed policy. Geopolitical events. Wars erupting all of a sudden. End of the year, rate cut optimism by the Fed fueling a historic market rally. All of these things. May 23. One for the books. But I believe that 23 was just the appetizer that will be forgotten. 24, on the other hand, will be the year to remember. It's going to be the year that's going to stun us all. Like I said, folks, we'll talk about the elections, the geopolitics, a lot of stuff. But we begin with the market here and the status of the economy, the scenarios that we have. What we know right now is we are at the end of the economic cycle. How do we know that? Well, the end of any economic cycle was always pretty much accompanied with a rise in inflation, a response by central banks that leads to a recession. We see financial markets crashing, and we reset a new cycle and we begin all over again. The problem becomes in the road leading to the end of the cycle. That's the tricky part, and that's where we can be thrown off. For example, those of us who held a bearish view in the economy and the market, we got our asses handed back to us in the year 23. Why? Because heading into 23, by the end of 22, the assumption was, okay, we got inflation, now the central bank is responding, we get a lot of recessionary data, so we're going to head into a recession, economy goes down, market resets. Easy, isn't it? Well, it was not that easy.
Okay, so they were expecting a recession in 2023, and that was the most anticipated recession in history. We've talked about that a lot on this show, and I can't believe that more macro analysts didn't lose following. They actually gained following from this, from all of this. And people who were more directionally correct on things, like myself, that it's crickets. So let's keep listening.
Had a lot of surprises along the way. For example, the data changed. At the end of 22, the assumption was that consumer savings will be depleted by the end of the year 23. Excess savings, that is. And that would be a mark of a recession. Because to eradicate inflation out of the economy, you need to reduce excess savings. All of those savings fueling spending in the economy have to be erased. Well, we got revisions to the data. And now we anticipate that that's not going to happen all the way till the end of 24. Not to mention, of course, the emergence of the AI mania, which added a market cap to 7 stacks, the so-called Magnificent 7, worth about $12 trillion, which is triple Germany's GDP. Insane? Sure. But nobody had that on their bingo card heading into 23.
Oh, yes, I did. I talked about it specifically, that why going into recession, you have stocks, specifically blue chip stocks, doing well. And it's the same thing that we continue to see even through the latter half of the year, 2023, and we will see in the first half of the year in 2024, at least through Q1. We might see them starting to roll over a little bit in Q2. I've showed the historical timing of going into recession. It's about 6 to 9 months before recession is when stocks, have this topping and start coming down. So if we have recession, say starting in Q3, end of Q1 is about when they're going to top and start rolling over. So yes, I don't know if lots of people did have the rise of blue chip stocks and the Magnificent 7 and the FANGs on their bingo card for 2023, because it was the most anticipated recession ever, and it didn't occur.
It was a year all in all when we saw corporate profits going negative. We have seen that the big cap technology stocks, as we covered in the previous video, managed to return into profitability again by cutting costs aggressively. That was among the unexpected heading into 23. Likewise, the increase of U.S. oil production was not expected heading into 23. But we got that by the end of the third quarter. We saw a massive increase in U.S. oil production. Elections reasons? Sure.
Who didn't have this on their bingo card either? This is one of my biggest calls. Yes, U.S. oil production is going higher. It's going to continue to go higher. He talks about OPEC here in a little bit. As you can see with Saudi Arabia, the OPEC has 5 million barrels per day of excess capacity right now. The U.S. can continue to go up. All that's stopping the U.S. is red tape and the desire to keep the U.S. tied to the rest of the world. But despite that, we continue to have increases in production in the U.S.
Sure, we'll talk about that a lot. The rise of U.S. supplies led to a reduction in prices, while at the same time, the impact of Federal Reserve interest rate hikes hasn't really been fully materialized in the economy. So we have seen a phenomenon of a reduction of inflation while economic growth remained holding, leading to the phenomenon that we call soft landing, or some would call it the Goldilocks scenario. Now, the problem with that, of course, is soft landing never really happened. Goldilocks never really lasted. The soft landing phenomenon is a transitory phenomenon. We see inflation feeling the impact of interest rates by the Federal Reserve, but we don't see the impact of those interest rate hikes fully realized in the economy. And this is why we never had a soft landing. We talked about that in details in previous videos. But I believe that heading into 24, those who are holding a bullish view in the economy and the stock market are making the same mistake of the tunnel vision that the bears have held heading into 23. Now,
it's not tunnel vision if the thesis or the theory includes 2023 through 2024. It includes a cycle. It includes where we're going in this whole cycle. See, the whole thing behind this is that we're at the end of a credit bubble. The Fed doesn't print money. The U.S. government doesn't print money. Money is printed in the commercial banking system, and also rehypothecation in the shadow banking system. So that's where money is created. We can't have inflation continue because we can look directly at the bank credit in commercial banks, and we can look at M2, and we can look at the shadow banking system, which is represented through yields. We see yields going down, which means the shadow banking system is not functioning properly. It can't support higher rates. So that means that the shadow banking system is contracting, as well as the primary commercial banking system is contracting. We're not going back into any sort of inflationary thing. We're sliding into recession. See, to go into a stagflation, to go into an inflationary period, you have to have money printing. You have to have credit creation and credit expansion. If all your metrics for credit are saying that credit is shrinking, you're not going to go back into inflation. Another thing, sometimes prices rise for deflationary reasons. Just think, higher prices that can't be supported by the market. He kind of talked about this when he's like, we went back and forth and we went from inflation now causing a recession and sliding into recession. The reason that happens is because rising prices were not met with rising money printing. Prices rose due to other circumstances, supply shock, war, sanctions. So prices rose. They weren't supported by extra money printing. So those high prices are unsustainable. You cause demand destruction, and then you slide into recession. There's no reason for recession to follow high CPI if there's money printing to support it. And if you believe that M2, or you believe in the Fed is printing money, and you believe that government spending is printing of money, then there's no reason to slide into recession. You just continue inflating, and you can continue growing, and all of this stuff. The market can support the higher prices. To have the concept that to slide into recession, the market can't support high prices. You can't be an inflationista. You cannot believe in all these sources of inflation. You have to believe that higher prices create a deflationary environment. Higher prices are deflationary. Okay, let's continue.
See the bulls looking at the data that they have right now, assuming that that's going to be the lasting theme, not realizing the inevitable scenario for an end of any economic cycle, number one. Number two, the road that we will have heading into that. With that being said, we have to discuss all three scenarios, what supports them, because we will see a thematic shift in the economy and the stock market depending on the flow of the data. At one point, we're going to feel, okay, this is supportive of a soft landing. We feel pretty good now. Next thing you know, the data changes, or we get some reinflation in the economy, the mood sours, then we get another piece of data suggesting that we have recession creeping in. We're going to go back and forth, back and forth.
Now, reinflation, that's not the proper term, is it? It's supposed to be reflation. So you have credit deflates. It actually goes down. Net credit goes down. And then you have a reflation going back to the original level of credit or whatever. It's not reinflation. That makes me think of the rate of CPI is going to go back up. I mean, you could have 1 month or 2 months that bounce up, but it's going to just cause further pain. If we have a reacceleration of prices right now, it's going to cause further pain and just make a future recession that much more imminent. So if Saudi continues to cut their oil production through OPEC, then prices will go higher. And it will just lock in a deeper recession following that, because you have to have actual credit creation and credit growth to support higher prices.
And this is why for us to understand these three scenarios, what supports them, and most importantly, how do we position our portfolios heading into 24? Because with the shift in these themes, right now we're mostly in the soft landing. Next thing you know, we have a reinflation risk. After that, we get a recession risk. Well, your positioning has to change.
This is how your positioning is for the first quarter. Bitcoin, at least probably 10 to 20%. Even that's extremely conservative, but some people could go up to 25, 50% in Bitcoin. You're going to be long bonds and you're going to be long big cap stocks. That's the pre-recession trade. You could be long gold too. I don't think gold is going to fall, but it's not going to perform nearly as well as those other things.
Change. And this is why, at least in my portfolio, which I'm going to produce for my Discord members, we will have exposure to all themes, but we will begin shifting from one theme to another, depending on the data. So we're going to be more active. Investing in 24 will be more of an active investing year versus 23, which was a passive investing year. 23 was pretty much if you have the S&P or you parked at the big caps, you outperformed. Your retirement account probably outperformed your investment account because there was very little choosing you can do. I believe 24 will be different because of the changes in themes. So we're going to be more.
That's a good point. So there's little else you can do. That's why the trade is going to continue into 2023 or into 2024. And then going into Q2, maybe you get less into stocks and more into bonds and Bitcoin. So the bonds are going to do great. Bitcoin's going to do great in 2024. Maybe when the 10-year hits like 2%, that's when you could say, hey, maybe it's time to diversify out a little bit and reallocate somewhere else. But that's the trade going into Q1 into Q2.
More active than passive. With that being said, the challenge for 24 will be cut expectations. We know for the most part, absent of an abnormal event, that the hiking campaign by the Fed is over. Now the question becomes how fast, how frequent, and how aggressive rate cuts will be. It seems that we have a divergence of opinions here.
Okay, so this is putting the cart before the horse. Trying to guess what the Fed is going to do is not, it just adds a layer of complexity that doesn't really have any causative effect here. The Fed doesn't matter. Get the Fed out of your mind. Try to predict what the market is telling you without thinking about the Fed. Then you are able to make a much better forecast of what's going on. So this cart before the horse. What is the Fed going to do? We got to decide what the Fed is going to do because that is the linchpin. That's the pivotal thing is what the Fed is going to do. That's completely wrong. The Fed follows everything else. What's the market going to do? Then you can predict what the Fed is going to do.
Specifically by the market and the Fed. The market anticipates rate cuts to happen as soon as March, and they will be really aggressive. At least 6 cuts in 24 alone, but with no economic weakness, with no recession risk at all. Rate cuts for the good reasons. Inflation going down while economic growth remains intact. The Federal Reserve and economists believe that, maybe we'll have rate cuts. Not as much as the market anticipates, and probably will be for the wrong reasons. It will probably be because we see the impact of Federal Reserve rate hikes on the economy, which will be negative for growth. To fix that, the Federal Reserve has to respond by reducing their interest rates slowly but surely. And hopefully that's going to happen with no accidents, with no recession. The battle of expectations will be pretty much the predominant theme in financial markets. The market will win if it gets what it wants, rate cuts, ASAP, for the good reasons. But if market expectations meet reality, and this reality is not favorable, meaning that either rate cuts will not happen as soon as the market anticipates, or they will happen for the wrong reasons, then the market will reverse all of the optimism that we ended 23 with and have a different look entirely. So again, let's discuss the 3 scenarios one by one, beginning with...
Okay, so he made a distinction there between rate cuts for good reasons, right? That they're going to slowly taper down into a more long-term neutral rate. And that's what Powell has been building his narrative towards. Slowly, cautiously lowering rates. And it's not because the economy is in trouble. See, the bad reason, according to Maverick here, is that the economy is going into recession. And so they're cutting rates to try to stimulate. But you can't, all of that thinking is just, there's no point to it. Okay? Because what the Fed is doing is not actually affecting the market. If you take that Fed out of affecting the market, now you're left with, okay, we can probably predict what the Fed is going to do because we are predicting what the market is going to do without the interference of influence of the Fed. So I think that the Fed is going to follow Powell's regular MO. And he kind of got into this a little bit at the last press conference. That as rates continue to fall, in a pre-recession trade or pre-recession period, that makes the effective and quote unquote inflation falls, CPI and PCE as they fall, that makes the effective tightness of the Fed's policy increase. And so they are going to sympathetically cut, just like Powell did in 2019. If you want to know what's going to happen in the first 6 months of this year, just look at the last 6 months of 2019. Powell cut 3 times. And that will come up again here in a later slide that he has when he's talking about the repo market. But Powell cut 3 times before recession. Then we don't know exactly what would have happened because COVID hit. But then he went, after those 3 cuts, he went to zero, like very, very quickly.
With the soft landing, which supports the soft landing theory. Number one, we talked about the increase of oil production in the United States. The supply is going high not because we're drilling more, but because we're pumping more out of existing rigs. Now, this could be political. Folks would say that the Biden administration is doing this for political reasons. It's going to be.
How could this be political? The reason why that the production per well is going up is because technology is increasing. They've been able to extend the life of existing wells. They've been able to start refracking older wells and producing as much as if it were a new well. So the technology is going up. It has nothing, absolutely nothing to do with politics. If you take out politics, the production would be much higher because there would be less red tape. And all of the big oil producers would be probably producing at least 50% more than they are now.
Being election year, doesn't matter. The impact is what matters. And the impact is we have seen gasoline prices going down. Well, we have that. What does that do? If we have somebody in the economy who still has a job and now they have to spend less on gasoline, more disposable income in their pockets, they can use that to re-stimulate the economy. Likewise, the expectations of rate cuts are good enough to drop mortgage rates to see the impact right away. This is why the housing market is always a leading indicator. So we see mortgage rates dropping big from almost 8% to now about 6.5%. In the soft landing thesis, we see that the drop in 30-year mortgage rates combined with a low unemployment rate reigniting demand in housing. So we see buying of housing again, activity resuming in the housing market, realtors making money now again, rent rates are moving higher, folks are moving around, they're using U-Hauls, storage facilities, they're spending on gasoline, they're renting cars, they're buying new homes, they're getting new loans. All of this stimulates new activities in the economy. That's the
true. And this is one reason why I think that this coming recession in 2024, could be deep but brief, because as these rates go down, there's a lot of pent-up demand in the housing market for refinancing. There's a lot of pent-up demand for just buying a new home. And so as soon as these rates start falling, when these rates get to 5%, which they almost certainly will in 2024, maybe even 4% for a 30-year fixed rate, I mean, that's a lot of stimulus out into the economy. A lot of stimulus.
The assumption, of course, that rate cuts, as we see right here, the impact in mortgage rates will be stimulative in the economy. Furthermore, what supports the soft landing theory is, what if rate hikes don't have that much of an impact as we've seen before? Meaning, sure, the Fed can raise rates, and this is going to impact the rate of new loans, of credit cards, of student loans, but not going to impact folks who are already in their homes. They own their homes. They got their fixed mortgages.
This is an interesting chart. Yeah, so the dark blue line is the effective mortgage rate. So the reason why it's not rising is because people don't move every year. People don't move into new homes every year. They stay in their same place for 5-10 years before they move to a new place. So this higher interest rate is going to take a long time to pull this up. What happens if this crashes? What happens if the blue line, which it already has, this is showing the top here, it's already down to 6.5%. Coming back down. What happens if it crashes all the way down to 4%? The effective mortgage rate is going to remain very low. And this is actually stimulus for the economy. But I want to compare this or contrast this to the rates on, like government debt. So as rates are high in US Treasuries, that is not tight. Okay, that's loose. It's the opposite of a mortgage rate. And maybe that's why people mix it up. But as rates are high in treasuries and stuff, it's because the economy can sustain that. The economy can meet that burden. That means the economy is doing well and the money is loose. As rates fall, people are getting defensive and they're going into safe and liquid assets. It's getting tighter out there. So as rates fall for treasuries, that means the economy is going into recession. It's tightening. The complete opposite of the mortgage rate.
A while ago, with lower interest rates, how are they going to be impacted with higher rates by the Fed anyways? And those folks were not impacted. Now they have more savings in their pockets. They use that money. They put it in a savings account with a higher rate. They bought maybe a T-bill, maybe in a money market fund, and now their wealth has increased. In other words, interest rate hikes was actually good for them, not bad. And now as we see mortgage rates going down and housing activities freeing up more and more capital, we see these folks, homeowners, at lower mortgage rates, using their money, spending in the economy again, and re-stimulating growth into the economy. And hence we have soft landing. But of course, the soft landing theory would not be valid if the unemployment rate rises. Well, for now, we're not seeing it. What we're seeing is...
Okay, that's only valid if we see interest rates not falling. See the catch-22 there? You can't have treasuries falling if the economy is doing okay. If what he says is soft landing is coming. So it is definitely a catch-22. Rates are going to fall. There's going to be more money out there, but it's going to be defensive. It's going to be put into defensive things. The Magnificent Seven, that's defensive. And I don't care what people say about, oh, stocks are not a deflation hedge and all this stuff, or a recession hedge. Of course they are. It's just for that brief period when the market does crash. So that 3 months, maybe the first 3 months of recession, maybe even go the first 3 months before and then 3 months into the official recession. That's a bad 6 months for stocks, but the rest of the time it's very bullish. Because are you going to hire another person, or are you going to put 60,000 more into investments and hunker down and save, put it into Apple and just save? So yeah, I don't it can't, the way he just described it, where rates are going to go down and then people are going to stimulate the economy. Well, if that's the case, then rates won't go down. But if rates continue to go down, we know recession is coming.
Is the rate of job creation slowing down, which is less inflationary. Okay, so if we still have jobs being created and folks still have their jobs, their savings have improved by higher rates, and now we see lower gasoline prices and lower mortgage rates, wouldn't this combination of all of these elements lead to more spending in the economy, which will lead to the resumption of stimulation of growth into the economy? This pushes the risk of a recession away, and if we don't see inflation coming back, then mission accomplished. We got a soft landing. So the soft landing theory has supporting evidence right now. The problem is if the resumption of growth leads to reinflation. And this is where the second scenario comes. Reminder, the leading indicators, housing and energy prices. Why? They respond more. They respond to the expectations of changes in the monetary policy. They don't wait for the change to happen before they kick in. So when you hear the talk about lags, when the Fed raises rates, there are lags. That happens for refinancing. That happens for new loans issuance, paying back debt. But there are also leading indicators before the Fed raises or cut rates. Those are housing and energy prices. We just talked about how expectations of rate cut.
You guys know my theory on lags. I think that they are overblown. No one can define them and no one can point to them. No one can predict them. They're almost completely made up to fill in a hole in your theory. Just like dark matter in physics.
Have dropped mortgage rates dramatically. With that, we see the resumption of activities in the housing market. The resumption of activities in the housing market could lead to an increase in pricing, and that's inflationary. The headline reads, October home prices post biggest gain of 23 despite higher mortgage rates, according to S&P Case-Shiller Index. That's the problem. We don't want to see home prices going higher again. We want to see home prices going down. Well, the problem is if you have re-stimulation in the economy and the restoration of purchasing power, then wouldn't that increase the demand for housing and push prices higher again? This is the problem that could lead to a reinflation phenomenon in the economy. Likewise, when we look at gasoline prices, they've been dropping down. But recently, in the last few weeks, as the Fed announced that yes, they see rate cuts 2 and 24. Not as much as the market anticipates, but sure.
Okay, again, the fault in the logic here is showing up again. So if mortgage rates continue to go down, or rates continue to go down, because the economy is heating back up, well, lost my train of thought there. So rates can't go higher if we're going into recession. Rates will come down. And I'd have to replay that. Let me replay that section so I can jog my memory of what I was going to say.
In the housing market could lead to an increase in pricing, and that's inflationary. The headline reads, October home prices post biggest gain of 23 despite higher mortgage rates, according to S&P Case-Shiller Index. That's a problem. We don't want to see home prices going higher again. We want to see home prices going down. Well, the problem is if you have re-stimulation in the economy and the restoration of purchasing power, then wouldn't that increase the demand for housing and push prices higher again? This is the problem that could lead to a reinflation phenomenon in the economy. Likewise, when we look at gasoline prices, they've been dropping down.
Yeah, I don't remember what I was going to say, but that is what we've seen typically since the great financial crisis, right? Housing prices go up, but that doesn't necessarily lead to general prices going up. Asset price inflation is real. It's where the new credit is focused into one aspect of the market. Now, the way that I see that refinancing and pent-up demand could affect the economy, or at least affect recovery from the recession to shrink the size of recovery in this coming recession, is because that refinancing is going right out into the market. Those people are taking that out and spending it. But housing prices in general going up is not a inflationary cause or cause for inflation. It is just a response to the general deflationary environment, focusing credit creation into new homes. But it's hard to explain because for CPI to really continue and go higher and be sustained higher, you need to have the private economy, which is like everyday business out there. It's a vast majority of people in the United States work in small companies of 50 employees or less. So those small companies, if they are feeling flush and they are feeling the economy is good, they're going to take out business loans. They're going to spend money. Then they're going to give their employees raises. They're going to hire on new people. See, and all of that creates more credit creation. It has nothing to do with just housing prices going up. That's actually a sign that it's being pinched, that all the credit creation is being pinched into certain aspects of the economy and not to the broader economy. The broader private economy is in depression. Asset price inflation has nothing to do with broader credit creation in the private market. It's actually a negative indicator of what's going on elsewhere. Okay, let's continue.
But recently, in the last few weeks, as the Fed announced that yes, they see rate cuts too in 24. Not as much as the market anticipates, but sure, we see them. The reaction to that was short covering in oil commodities and interest in buying those energy commodities. Why? Because the dollar went down. If you're going to devalue the dollar with expectations of rate cuts by the Fed, then demand for energy, demand for crude oil goes higher. For now, gasoline prices are low, relatively speaking, at least to 22, 21. But the fear is that if the Federal Reserve cuts rates indeed, are we going to see phenomena such as the ones we've seen back in the year 2008, when we've seen volatility in energy prices as we fluctuated from soft landing, recession expectations, reinflation, and then when the Fed finally cut rates in September of 2007, we have seen a resurgence in energy prices, and oil prices shot up significantly higher, leading to higher prices at the pump for the consumer. And that was one of the factors that led to the recession. Are we going to see that in 24? That's the risk of reinflation. It's not here now, but it is a possibility. As we see more devaluation of the dollar, and we see rate cut expectations being amplified, that leads to expectation of regrowth in the economy, and with that, demand for gasoline. Another supporting evidence for the reinflation outcome is China. China has been weak. Heading into 23, we all anticipated that, China is going to reopen. Well, China reopened, but we haven't seen demand by China resuming. Demand was really weak, and it remains weak. Question now becomes, what if the Chinese government decides to issue a stimulus? If they do that, well, stimulus leads to stimulation of growth, stimulation of demand in the Chinese economy, which means more demand for commodities. So when we talk about a supportive evidence of the soft landing theory is lower.
Okay, so the reason why this is not going to happen, why China is not going to reaccelerate, is because if they've found out that if you stimulate the household sector over there, what happens? People plug it into savings. They don't actually go out and consume. They're stuck in this middle income trap. It's a very well-known phenomenon. It's happened over and over and over again. Throughout history, like for the last couple hundred years, this has happened over and over again. Even the Great Depression Michael Pettis has made this argument that the Great Depression was the U.S. getting out of the middle income trap. So if you have to have max pain, China has to have max pain. That is not going to, stimulus is not going to work. Their whole economic model is falling apart. So increased demand from China isn't going to come to fruition.
Gasoline prices. Well, we see already that not only supply has increased above expectations from U.S. producers, but global demand for oil is also increasing above previous expectations. It's a no-brainer. If we have demand exceeding supply, prices go higher. If we have, as we do right now in the oil market, supply exceeding demand by a little bit, we see pricing going down. If China issues a stimulus, demand for oil will increase, while the supply we see a rise in supply from U.S. production, but Saudi...
Okay, so let's just hear what he says about Saudi.
Russian OPEC production is down. That could tip the balance in favor of demand versus supply in the oil market.
Okay, the reason why OPEC production is down is because they cut. It's voluntary cuts. They have 5 million barrels per day of excess capacity. If oil goes to 90, they're just going to reverse their cuts. And the market knows that. So there isn't I don't know. Let's read what this chart says. The EIA medium-term forecast going out to 2028. It's coming down, not getting to 2019 peak. Oh, this is interesting. So people that listen to my stuff, you'll know I'm kind of a peak oil demand person versus peak cheap oil or peak oil, and where oil is going to continue to get more expensive. I think that we've hit peak oil demand, at least for the coming decade, maybe even going out 50 years, because we have demographic collapse around the world, and we're just going to demand less energy as a civilization or as a planet because we have this demographic problem. And there's other things like people are moving to hybrids, people are moving to electric vehicles. Whatever your thought is on electric vehicles, it is the case that there is at least a marginal push in that direction. And hybrids too. By the way, the hybrid stuff, I think that's genius. I really think that most cars will probably be hybrids in the next 10 years because you can just get so much more gas mileage out of them. And, that is going to force this oil demand or demand for gasoline or whatever down. People don't understand how important the Western economies are, or the big economies, including Japan, including China and stuff, because one U.S. consumer is worth 20 consumers in Africa or 20 consumers in some of the emerging markets. So the marginal consumer in the United States is much more important than the average consumer anywhere else. And if we're going towards, if the marginal consumer is going hybrid, I mean, that's going to be a huge cut in demand for oil. So anyway, my big thing is peak cheap oil, or peak oil demand. And it's funny that the IEA has also said that they're more into about renewables and stuff than demographics and economics, but very interesting. And then the white line is actual demand and short-term forecast. So it's gone above that. Let's see, we're into 2024 here now. That's interesting, but there also could be an effect of refilling inventories. I asked this of Shy Girl on Twitter maybe a couple weeks ago, and because she was talking about the demand hitting highs, hitting all-time highs and stuff. I said, well, how much of that is going into inventories around the world? China is chock-a-block full now. Their SPR over there in China is extremely full. The U.S. is probably going to they've already started refilling the SPR. Maybe other countries are doing the same thing. So maybe that demand that's just, looks like it's going up. Maybe that is a lot from refilling inventories. I don't know. But anyway, interesting chart. Okay, let's continue.
To mention the geopolitics, of course, and that leads to reinflation in the economy. The recent devaluation of the dollar alone has led to the prices of many commodities to rise higher, specifically metals. If you see the prices of iron ore, for example, they've been moving higher, as anticipation of rate cuts lead to the devaluation of the dollar. You combine that with Chinese stimulus and resumption of demand by China, you will see the prices of these metals skyrocketing, and that would be inflationary for the economy.
Now, how come he doesn't show this all the way back to the Great Financial Crisis, which is what I'm going to do right now, actually. Let me go back to, let me find it first. That says Singapore, right? So let me find that. I think this is it. No, that can't be it because it stops. Sorry, I'll find the right one. Just a second. Oh, that was Hong Kong. Okay. I think this is the one. Let me go to the weekly chart. Oh, but it doesn't show going back to the Great Financial Crisis. So we're lower, though, than the end of 2021. Now let me go back to his chart. Come on. So his chart does show a little bit of, well, the beginning of 2022, or at least half of 2022. So, 2021, if you zoom out, this story doesn't make any sense. Iron ore is going down versus 2 years ago. It's still lower. Same with oil, same with all these other things. Why would marginally higher iron ore prices, nowhere near all-time highs, nowhere near where it was back in 2021, why would that mean there's going to be an increase in inflation? Most likely it's not.
We talk about the devaluation of the dollar. The challenge becomes the synchrony between central banks. So far, they haven't been at conflict yet, even though we talked about this theme in numerous videos in this channel before, that at some point the Federal Reserve will be against the ECB, against the Bank of Japan. All of them will collide together because of the currency war. If the Fed decides to cut rates, that's going to devalue the dollar. Okay, what is that going to do to, let's say, the euro? The value of the euro will go higher, which reduces...
Okay, just what you said there. If the Fed decides to cut rates, that's going to devalue the dollar. Absolutely not, man. Absolutely not. Look at the history of the dollar going back to the Great Financial Crisis. QE and 0% interest rates strengthen the dollar. Or they don't, there's not a causative relationship there, but they coincide. Strong dollar happens because of reasons that also makes the Fed put rates down to zero. They coincide. There's not lower rates doesn't devalue the dollar, people. So the whole premise is skewed here.
The rate of tick inflation, it increases the purchasing power for European consumers. Sure, so we could see services inflation receding, going down by a little bit. But then commodities inflation, that is tied to the dollar. If the value of the dollar goes down, then prices for commodities go higher, including energy. And that's going to lead to reinflation in the headline inflation rate. So now if we look at the ECB projections here, it reads that euro area inflation probably reversed course in December. Why? Because of the devaluation of the US dollar. So you see that headline inflation in blue, the expectations are this is going to rebound higher in Europe. But the rate of core inflation, the line in yellow, will probably continue to go down little by little by little, be at a slower pace here. That's all because of the devaluation of the US dollar. Now it's going to be worse for the US consumer because...
Oh my gosh, devaluation of the US dollar. Let's go back to the charts real quick and check out the DXY. Devaluation US dollar, people. What does that look like? These are my boxes from previous. This is a stair step going higher for or during financial crises. And you see a great financial crisis. It's just been up, and it most likely will continue to do that. There is no devaluation of the dollar. Another thing, let's look at oil. and we can go back in time. Let me take all these drawings off. If we go back in time to the great financial crisis, dun, dun, dun. I mean, we take the middle of that. That's right where we are. I mean, oil prices were up here. I think this is around 100. I don't know why my scales aren't working right. How come my scales aren't working right? Anyway, back here it was around $100 a barrel all through 2011 through 2014. And now we're at $72 a barrel. Oil prices are lower. I've drawn this many times. There's a channel here that you can draw that is showing just lower prices since the GFC. We've gone down. And this little spike up here being the sanctions on Russia, that is, I mean, yes, it's a fundamental in the market, but you know why this spiked up here was because of the sanctions placed on Russia and the invasion of Ukraine. It wasn't from like fundamentals of supply and demand in the underlying economy. Okay. It was a supply shock. So, I mean, we could take a look at gold as well. Gold should be tracking devaluation of the dollar, right? And since the great financial crisis, well, it went up after the great financial crisis. But if we go right here, 12 years ago, in August 2011, I mean, it's pretty much been lower or flat in that 12 years. It's not like we devalued dollar a huge amount, according to gold. So where do people get this devaluation of the dollar? It's because they're looking at things like M2 and the government debt, and they think that's money printing. It's not money printing. Okay, let's get back into this.
Of course, not only we're going to see reinflation commodities prices, the devaluation of the dollar, but also the purchasing power of the U.S. consumer will go down. And that could lead not just to reinflation in the economy, but also stagflation phenomenon. So now that we talked about the soft landing risk and the supporting evidence, the reinflation risk and supportive evidence, let's go back and talk about the recession risk and its supportive evidence that we have here. We begin with, what about regional banks? What about Silicon Valley? That bank collapsed, then came First Republic banks and many other banks that blew up.
Now, I guess the point of this video is that the reason why he has to go through all of these soft landing and reinflation, which is a term that I think he's using incorrectly, and a recession, is because he can't dial it into which one, because he has wrong interpretations of the individual components that support the different theses. All of the things I'm looking at are showing recession, recession, recession.
Is that over now? Not really. The Federal Reserve decided to place a Band-Aid on top of that, and it worked for now. That's only kicking the can down the road. At some point, all of these lending facilities will have to be over. All of these regional banks and not so regional banks who are continuing to borrow money from the Fed at a higher rate have to pay it back at some point. Do they have the liquidity to pay it back? That's going to be a problem. Not to mention, of course, the fact that the unrealized losses for these banks from the bond positioning alone is huge. While we see that bond yields went down and bond pricing improved a little bit, it's not enough to cover for all of these unrealized losses in the bond.
Okay, unrealized losses. What happens to these unrealized losses when rates crash? They go away.
Bond positioning and fixed income positioning by these banks. They need to have rates going down to zero. Otherwise, they're going to have to face this problem sooner than later. And continuing to lend from the Fed is problematic by itself, because a lot of you would say, hey, Maverick, all of these losses in the balance sheet for banks don't matter, because whatever exodus in deposits that they're going to cause, the Federal Reserve will lend these banks money. And how are you going to beat that? Well, understand that now they have interest rate liability on top of their unrealized losses. Things are not getting better for regional banks. And you're going to need re-stimulation of growth in the economy by a lot, and a reduction of interest rates down close to zero to stop the bleeding in deposit exodus, improve these unrealized losses on the balance sheet for banks, and resume their revenue growth by re-stimulating loan demand in the economy. A lot of things need to happen to prevent the blow-up of regional banks and many other banks, not to mention, of course, all of their bad loans that most of us who are not working at those banks, who don't have that kind of information, have no idea about. Those bad loans will have to be refinanced at a higher rate. What if these banks continue to eat more and more losses in these loans? The systemic risk of a blow-up in one of these banks supports a recession scenario as we've seen back in the year 2008. Another supporting evidence for the recession scenario, and honestly, the stagflation scenario, is the issuance of bonds, T-bills, by the Treasury Department. We know that the issuance has been increasing because of the fiscal spending, the fiscal needs of this country. Now, you and I might have different political views. I think that we have excessive spending in the economy. You might think it's a necessity. It doesn't matter at the end of the day. You can either finance it by increasing taxes, or you can continue to issue more and more debt. The problem is, in the past, the Federal Reserve was the buyer of all of this issuance of bonds, so it didn't.
Okay, one of the problems here is that, first off, of course, government spending or government debt is not money printing, but it also is deflationary. It's not inflationary, because government spending is not as productive as private spending, right? So it's an exchange of private use of that money for public use of that money. You get less growth out of it. So if the government has to spend so much money, it's signaling bad times, ahead, which will make people defensive, which will put people in, or which will pull the economy into recession. So government spending is recessionary, or not recessionary, deflationary, because it stops from the private sector from being so robust.
Matter if we have a deficit, didn't matter if we spent beyond our means. The Fed was assuming the buying of those issuance. Now the Fed is in quantitative tightening, not quantitative easing. Now that is dumping bonds, not buying them. At least they're trying to dump their bonds, without causing a disaster, because if we have the Treasury Department along with the Fed dumping bonds.
The Fed isn't dumping bonds. The Fed is letting bonds roll off their balance sheet. They aren't selling them. They're just not replacing them.
Together, we have a blow-up coming. So we have seen this year coordination by the Fed and the Treasury Department. In the beginning of the year, the Fed was indeed doing quantitative tightening and dumping bonds. Then came the deluge by the Treasury, issuing bonds. The Fed backed off a little bit, and there was somewhat of a balance here. And it did not lead to a huge increase in interest rates or bond rates. We've seen some of that in Q3. The 10-year yield blasted higher to 5%, causing problems in the equities market. But after that, the Treasury Department came out and said, okay, we're going to reduce the deluge here all the way to 24. And then inflation data came out soft, and a lot of folks said, okay, now the Fed will not have to be aggressive in quantitative tightening, and they might reduce rates themselves. So we've seen rates in the 10-year bond going down. But like everything in this economy, we're just kicking the can down the road. At some point, the Fed and the Treasury Department will have to collide. The Fed has to reduce their balance sheet. At the same time, if the fiscal spending continues to go on in an election year, who's going to finance all of this spending? We have to issue more bonds. And the problem here is the issuance of more bonds.
Okay, I've talked about this a lot in the last couple months or so about the shadow banking system. So the demand for treasuries is not just out there in a primary market, at least most of it. The average treasury is rehypothecated 7 times, let's say. There's not a perfect measure of this, but I've seen estimates between 6 and 20 even. So the average U.S. Treasury is rehypothecated 7 times. If that just goes down to 6 times, if the supply, so sorry, I'm having a hard time describing this. That rehypothecated Treasury is meeting demand in the repo market, in the shadow banking system. But if it's rehypothecated less, that demand is not filled in the shadow system, and it has to come out into the primary system, into the light, and buy treasuries on the open market. So that demand doesn't go away. It's the ability to rehypothecate and keep the market reflated or inflated. See, the deflation is the stopping of this rehypothecation flow, and the demand, because you're going to be insolvent. You have to get your overnight money. You have to. We estimated this the other day. I can't remember what the exact topic we were talking about, but we estimated with the numbers that we were looking at about 200 billion a night, and just in the U.S. was needed every night rolling over. And if you don't do that, boom, you're insolvent. Boom, rates spike. Repo rates spike, and you have a freeze in the repo market, in the plumbing of the system. So it doesn't matter really how many treasuries the government issues, how much money they borrow, how much of the supply of treasuries there is in the primary market, because the shadow banking system is rehypothecating it. The more of the supply that is not rehypothecated is actually a sign of sickness in the economy. If the economy is functioning well, then you would be able to rehypothecate. You would be able to pump up the supply by 10 times in the shadow banking system. But if they can't do that, they had to come out to the primary market and meet their needs there. So I don't know if that described it well. There's an infinite demand out there for treasuries. Okay, let's keep playing.
Bonds, more supply, no demand. What's that going to do? Bond prices will go down again, and we will see the rates on those bonds moving higher. That would be the equivalent of financial conditions tightening in the economy again. You see, what led to the stock market rally in the fourth quarter was the loosening of financial conditions because rates on bonds went down.
Okay, that's the opposite. If rates are going up for treasuries, money is looser, not tightening. It's the exact opposite of what he said. He's like, as the rates go higher, that means that the liquidity, or what term did he use? Just money is tightening. That's the opposite. As rates are going up, that means the economy is loose. The reason rates can go up is because the economy is flowing and functioning properly and well. As rates are coming down, that's when it's getting tighter.
Expectations of Federal Reserve rate cuts went high. The combination of both led to loosening of financial conditions and led to a rally in the equities market. This dynamic could change if Janet Yellen can dump more bonds in 24 to increase fiscal spending and cover for the deficit. The question becomes, can the Federal Reserve just continue to hold in their quantitative tightening operation? Or will the Fed also join the Treasury to dump bonds, which will lead to skyrocketing rates on bonds because the demand will never meet the supply? Foreign buyers will not cover for the huge supply in bonds. Likewise,
demand will never meet the supply. You hear this all the time in traditional macro people. That demand, who's going to buy all of our bonds? Who's going to buy all of our treasuries? That we're going to run out of demand. And what happens when they say that? Rates actually fall. We turn onto the auction website and we can see that indirects, which are foreign buyers, are buying higher and higher percent of all the issuance. There's an infinite demand for bonds. We don't have to worry about, or treasury bonds. We don't have to worry about demand not being there. They can issue as many as they want, honestly. Now, that doesn't mean that that's good. People might mistake this for thinking that's good. It's not good that they issue this and that we get into more debt for the government. But the way the system works, as it's currently constructed, there is infinite demand. It doesn't matter how much is printed or how much is borrowed by the government. The more it's borrowed, the more the economy weakens, the more the shadow banking system has problem rehypothecating, and the more of that shadow demand spills out into the primary market. So it doesn't matter that this whole system, though. Okay, now this is where I probably people will agree with me, is that this system will eventually not work. This system will eventually grind us down to 0% growth, 0% money velocity, 0% of economic activity. That is the absurd extreme. Before we get there, though, they can short circuit this deflationary grind, and they can short circuit it by backing the currency. So that's why I think we're going to go back to a commodity standard, and this time will be a Bitcoin standard. They will back the dollar by Bitcoin, and it will be at some super high set rate. They have to do that to be able to go back and make the system solvent again. You can't print debt to get out of a debt problem. The only way you can get out of a debt problem is if you take the commodity, you back it, and you pump up the value. So if say in 5-10 years, Bitcoin's price is 1 million on open market, and they decide to back the dollar with Bitcoin at a $10 million valuation. That creates a bunch of dollar value out there in order to go back and pay off the debt. So see, that's the only way you get out of this whole problem, is by changing the system. And that's going to take it's going to be a huge change. It's going to be on par with Bretton Woods. It's going to be on par with, it's going to be bigger than like the Plaza Accord when they devalued the dollar. It's going to be bigger, I think, even than 1971 because the dollar was already officially or unofficially, technically severed from gold. So this is going to be a massive, massive change that's going to have to happen. And that's where I think Bitcoin is positioning itself for. So, yes, I have an out of consensus view on what's going on with the economy and why we're stuck in this deflationary problem and what government spending means. We're never going to run out of demand for treasuries because of the way that the system is constructed. It's been constructed in this way, like intelligent design for the system. It was constructed in this way. And so it's going to continue to grind lower. There's no way out of it. It's a nonstop process to zero growth. The only way to get back out of it is to back your money with Bitcoin. Okay, let's continue.
If the banks are forced to buy these bonds, then the banks will have less liquidity to stimulate the economy, and that's recessionary. And that leads us to another supportive evidence of the recession outlook for the economy: tightening lending conditions. The headline reads, U.S. consumers will soon wake up to out-of-control interest on their credit cards, economists say. What are they talking about? The rate on your credit card loan increased, and you had to spend more using your credit card because inflation went higher. Your wages didn't really catch up with the rate of inflation. Now you have an enormous amount of debt. Can you pay back this debt at a higher rate? And if you can't, then we see the delinquency rate on credit card loans increasing. If you look at the percentage change from a year ago, delinquency rates have exploded higher. That is a sign of stress on the economy and consumer spending. And if the consumer is squeezed and choked by higher rates and the debt that they've already accumulated, how are they going to stimulate the economy? Rate cuts or no rate cuts? The debt has already incurred. They have to pay it back before they can stimulate growth and spending in the economy. So that supports the recession outlook of the economy. We'll look at the delinquency rates for all loans, not just credit card loans, all commercial banks. We're now moving higher. Not as high as the recession in 2009, but again, in 2006, 2007, we've seen a rise in delinquencies. It was a no biggie. It was not an explosion in delinquency rates until it happened. These things...
I mean, this is an interesting chart because you can see back in 1990 when it went above zero and delinquency started rising, we went into recession. Then in .com in 2000, 2001, same thing happened. Of course, great financial crisis and COVID. Even we had a recession with delinquencies going up. And now, is this an extension? I've talked about this as well. And I remember, man, when did I bring this up first? Back in 2020, I believe, or 2021, we were interviewing Danielle DiMartino Booth on FedWatch for Bitcoin Magazine. And I asked her if she thought that this recession, the COVID kind of recession, was just an extension of 2019. Like 2019, we were running into recession already, as you can see on this chart. It was already, delinquencies were already starting to go up. Recession was already kind of in the cards in 2019. And then we have delayed it with this whole pandemic policies of lockdown and stimulus checks and that kind of thing. Did we just delay it? Are we just going to have the recession now that we should have had before in 2020 if COVID and if the pandemic response hadn't taken place? I think so. I think that's where we're kind of at. But anyway, so we have delinquency rates rising here again, and it's almost certainly going to take us into recession.
Things happen really, really fast. Now we're trending higher, not lower, and that increases the recession probability in the economy. Likewise, tightening standards for loans by commercial banks for small firms, meaning small businesses in the economy, the core and the heart of this economy. If these standards are increasing, then we have tightening of these conditions. It's not easy to access a loan as a small business. What's that going to do? It's going to lead to less spending in the economy, less hiring in the economy, and that supports a recession outlook. Now, we have seen that standards loosened a little bit as of late. Would that be enough?
Okay, he says loosened as of late over here, except that's the wrong way to read this. This is like a PMI, where if you're above the line, standards are tightening. If you're below the line, standards are loosening. So this last month, or the last SLOOS data that they had, it was something like 50% of banks were tightening standards. Now it's down to 30%, but it's still 30% are tightening from the last reading when they were already tightening. So this is cumulative effect. So you can see that it's still in big trouble. And they also have, this is the tightening standards. They also have a complementing one of demand for commercial industrial loans. And the demand for commercial industrial loans is also falling. So you have a place where you have tightening standards and demand is falling. Credit creation is going through the floor, guys, through the floor.
Would that be a beginning of the trend of lending standards improving, or are we going to see them tightening again as rate cut expectations by the Fed are pushed further down the line? And it is a similar look for tightening standards by banks to large and middle market firms. We see that standards are really tight right now. That's recessionary. That's going to slow down the economy. We've seen an improvement as of late. Will that last or reverse? If it reverses, we see standards being tightened even more because of pushing rate expectations further down the line, or because banks have to spend their money buying bonds instead of issuing new loans, then standards will tighten even more, and that supports a recession in the economy. Recently, we have gotten the Chicago...
Banks don't use money to make loans. Banks create money in loans. That's why they're the source of money printing. So he's like, they're going to have to use that money to buy bonds instead of make loans. No, they don't spend money to make loans. I don't know where I could expand on that, but we're already here going on over an hour. So let's continue with this.
Chicago Business Barometer, it reversed down in the month of December to a rating of 46.9. Now, in the month of November, the rating was 55.8, so this is a sharp drop in the month of December. That also supports a recession outlook. Recently, we have heard from many retailers saying that demand is going down. We're not seeing consumers spending as we used to before. Consumers are waiting for deals and discounts, which reduces the pricing power of these retailers, which means less margins. It's not just a story for retailers. Recently, we've heard from airlines, FedEx, Nike, all of them warning that, hey, we're losing our pricing power here because consumer demand is weakening, which means less profits, less margins. And oh, by the way, worst case scenario is if consumer demand continues to be weak. But we see a resurgence of inflation in gasoline prices, for example. Now, that's an additional cost to us, businesses, not just the consumer. But we can't remedy that by increasing prices anymore, meaning that corporate margins will continue to be reduced. That's recessionary. A leading indicator to that is the data that we got from China recently. China factory activities post the worst contraction in 6 months. Well, gee, if the economy was about to improve and consumer demand to be resumed, then businesses will be replenishing their inventories. We should be seeing factory data from China improving, not contracting. So the evidence here is recessionary, not pointing to a soft landing or even reinflation in the economy. And the last supporting evidence for the...
Okay, let me go back to that chart because that's an interesting chart. You can see here in contraction for most of the last 2.5 years. There was a little during the reopening hype at the, I think March of 2023, it kind of went higher, but then it went back negative. So they've been in contraction for over 24 months. And the U.S. now, the PMI just came out this morning for the U.S., and our manufacturing has been in contraction for 14 months. So if you're a bank and you're looking at this, you're looking at China PMI, there's no stimulus, there's no economic activity, everything's crashing over there. You look at the U.S. economy, we have, they just said that he just showed like FedEx and airfares and all this stuff are showing decreased consumer demand. People are waiting for deals. Now you're a banker. Are you going to lend out there to businesses? No, you're not. You're going to tighten standards. And if you are a person struggling to make ends meet, are you going to bring on more debt if at all you can avoid it? No, especially if that is like a business debt, to take out debt to maybe acquire new vehicles for your firm or to take out debt to add on to your business, add a new assembly line or something. No, you're not going to do that. So there is credit creation is dropping. And when you are talking about recession or deflation versus inflation, you have to talk about net credit creation. So the amount of money that's paid off every month or every day versus how much is lent every month or every day. If there's more paid off than lent, it's actually a contraction in the money supply. And contrary to what many Bitcoiners will say, decrease in the money supply is not good. That's why Satoshi did not make Bitcoin as a deflationary or a currency with deflation. He made it a fixed supply. Now that is different than deflation. Gently falling prices are not deflation. Just like rising prices is not inflation. Rising prices can be deflationary. causing a destruction in credit creation and a downward spiral. That's what we saw or have been seeing. So no, deflation is not good. And when net credit creation is negative, which we can look at bank credit, it's negative right now, net credit creation. That's deflation is happening. We're going into recession. There's no reason to have this barometer, this whatever he's using to say recession, reinflation, or soft landing. No, we know we're going into recession. It's coming because of all of these other metrics I just talked about.
6 months. Well, gee, if the economy was about to improve and consumer demand to be resumed, then businesses will be replenishing their inventories. We should be seeing factory data from China improving, not contracting. So the evidence here is recessionary, not pointing to a soft landing or even reinflation in the economy. And the last supporting evidence for the recession outlook for the economy is what happens overseas. What if the systemic risk is not here? We talked about regional banks, we talked about commercial real estate before in details in this program. What if the blow up comes from a war scenario overseas? What worries me is the UK economy. They still have a really high inflation rate. It's been dropping, but it's still way higher than the US. At the same time, we see the UK economy shrinking, meaning that we have somewhat of a stagflation phenomenon in the UK. Recession meets sticky, higher inflation. What if that combination, regardless of what the Fed does to the US, of course, it will be worse if the US dollar is devalued. But what if the dynamic in the UK leads to a blow up of a major lender, a major bank? And that leads to the beginning of a contagion impact, not just in Europe, but globally. Well, that's going to be recessionary. That's the blind spot in the mirror that nobody's paying attention to right now. Anyhow, now that we talked about these 3 possible outlooks here and outcomes for the economy, soft landing, reinflation, and a recession, discussing the supporting evidence for each scenario, the question now becomes, how will the Fed respond either way? Because that's what we really care about. The response by the Fed is what really matters in determining whether we go into a recession or reinflation or so.
Oh my gosh. The response by the Fed is what really matters. I was just reading the comments, and Dex Invictus said that Maverick of Wall Street is a clown and a perma bear. Yeah, I'm getting that here. It came up in my feed as recommended, and so I started watching it, and I was like, hey, this guy is sounding like a normie understanding of the economy. So I wanted to, and he had a lot of followers, a lot of subscribers. So I said, hey, I'm just going to respond to this. But he said there, all that matters is what the Fed is going to do. No, the Fed follows the market. All right, let's see what he says here.
Soft landing. And before discussing these scenarios by the Fed, we got a lot of questions about what happened recently in the repo facilities. For example, the inflows into the reverse repo facility hit over $1 trillion. The expectations were for $800 billion. So there's a huge inflow into the reverse repo facility. All of a sudden, by the end of the year, we have volatility back into the repo facility. Is that a problem? We see the SOFR rate rising to all-time highs, 5.40%. This is the secured overnight financing rate. Is that problematic? Now, we know that by the end of the year, a lot of books are being closed by banks, so it is not unusual to see big...
Okay, Jeff Schneider was talking about this as well. I haven't been watching Jeff's recent stuff because I don't, it's... Right now, I think that the economy is going to be doing okay for the next 3 to 6 months, and I don't need to worry about what's going on there, what he concentrates on. But I did see that he was talking about SOFR. But look at this. Look back in 2019. I mean, this is very volatile with a lot of spikes going around. That's normal. So the spikes here, I mean, we should expect some spikes in this rate, but he's going to talk about the September spike. And what I want you to notice as well in 2019, going halfway through the year, is that first rate cut in July of 2019, and you can see it right here in the middle of 2019. And then we had the spike in the repo after that. So Powell saw that there was something brewing. And that was back, I think, Zoltan Pozar. That's when he burst on the scene. He was talking about this coming repo problem. That's where he made his name in 2019. And so Powell saw this. Powell cut sympathetically in July. And then by September, end of Q3, by the way, we had this huge spike in the repo market when U.S. Treasuries went bidless, especially off the run treasuries versus on the run. So the difference there is that there's, some treasuries are old. They've been around for a long time. Some treasuries are the brand new issue. The the most recent 6-month Treasury bill, that's on the run. Those are the most desired and most pristine. Sometimes banks or these people in these repo markets, the counterparties, they won't accept off the run. They will only accept on the run because those are seen as the most pristine. In September of 2019, off the run went bidless. No one wanted them because no one trusted the counterparty. Same with on the run. They actually went bidless for a brief period of time. That's why we see this huge spike as people will build up. They say, we need it, we need it, we need it. We'll pay you 10%, we'll pay you 20%, we'll pay you 30%. That's why this spike happened, because in the repo market, in a split second, they lost access to treasuries. So they bid up the price. But anyway, so that's what he's talking about here. Let's keep going.
Big inflows, not as big as we've seen, but big inflows into repo facilities, specifically the reverse repo facility, and we see that the SOFR rate rising higher. This is not unusual. The problem is if it leads to a phenomenon such as the repo crisis that we got back in 2019, when the SOFR rate exploded higher. We see it moving higher right now. If it doesn't stabilize as we enter the new year, we could see a repo crisis again, the likes of 2019. What if that leads the Fed to initiate a preemptive rate cut? Because if that happens, we will see the stock market going down, we will see rates going higher, so the Fed will have to respond by doing a preemptive rate cut. That will increase the risk of reinflation in the economy. So if you see that happening, the dollar is going to be devalued by a lot, and the move by investors should be buying metals. Gold, silver, steel, iron, copper, palladium, platinum, any metal will do pretty good under these circumstances. But absent of that, we are right now.
Okay, so that's where I'm going to end it. He talked about the commodity space there at the end. Let's take a look at some of those commodities. So we were looking at gold here previously, but let's take a look at, he mentioned copper. And this is a monthly chart. So copper actually it was one of the only ones that did make a new all-time high recently during 2021, but not by much. And a lot of that was driven by demand from China. They were scared that the international supply chains were going to break down, and so they really hoarded a lot of copper. So that's why the price went up. I do expect this to come down, but if you just go back to the Great Financial Crisis to today, prices for copper are generally the same. Once again, we can look at that. He said palladium coming down. No reason to think that it's going to reaccelerate. Let's look at some agricultural stuff. So we can look at corn. Corn also, let's see if it made an all-time high. Just barely made an all-time high back here in April of 2022. But remember what happened there. Russia invaded Ukraine. And so they are big wheat producers or corn, I guess not corn producers, but it would affect prices of substitutes and affect prices in the agricultural sector. So that marginally higher high was driven by that, not by any of the quote unquote money printing that people say. Okay, so then it's down, doesn't look like it's going to reaccelerate, and doesn't look like really net. Does this look like there's been a high amount of inflation in the last 14 years, 15 years? No, it doesn't. How about soybeans? Same. Does not look like it's going to reaccelerate. This is wheat futures. This big spike, of course, April 2022 with Russia and Ukraine. But also, no, it doesn't look like there's been a high money printing even when we look at wheat. How about live cattle? Now, this is an interesting one. This really went high, and I don't know. I don't follow the ins and outs of all these agricultural commodities, but this is an interesting one. The live cattle made a significantly higher high, I would say. After the Great Financial Crisis, it looked like it was, trending in the same general direction as all the other commodities, and this really boosted up in August 2023, hit a high. How about hogs? Lean hogs, same story. Been pretty flat since the Great Financial Crisis. No, don't see really any net money printing going on there. Cotton, same thing. Lower high. Doesn't look like there has been much net money printing. So you can go through all sorts of commodities and look at these things. And this money printing narrative is not there. I mean, here is nickel. It only goes back on TradingView back to October 2018, but it is significantly lower. How about aluminum? Aluminum, this goes back to 2014, and you can see we're right here in this general mid-range for aluminum. No sign of money printing and all that. So those are kind of the macro charts that I watch, and I look for signs of money printing that these people are talking about. Let's take a look at Bitcoin price before we go. This has been a long stream today. I don't know why I need to refresh the page, but I don't want to do that while I'm live streaming. So right now, let's see. We are currently at 42,946. Big wick coming up. Let's see if we can recover by the end of the day. We'll see. If we can break through, what would this level be? The close of this candle, 43,000. So if we can get above 43,000 and start heading higher, that will be very, very bullish. And maybe it will calm some of my anxiety over this ETF approval or denial. And if you missed what I was talking about at the beginning of the show, you can go back and watch that. But okay, guys, long-winded live stream. Hope you guys learned something. Hope I explained maybe my out of consensus views on a lot of things, because people are confused out there, and I'm just trying to bring clarity to the macro space and to the Bitcoin space, because I think the macro analysts, like say Luke Groman or Jeff Schneider, or who else is out there that's like George Gammon, these guys don't quite get it, and they're very popular. They're out there spreading confusion. I'm trying to spread a little bit of clarity. And then on the Bitcoin side, we have a lot of people on the inflationista side of the house, and I don't think that's what we're going to see going forward. We have to think in a deflationary, recessionary grind mindset. Any sort of higher prices is going to lead to a deeper recession. If we get higher reacceleration of prices, we'll just get a deeper recession coming quicker, more quickly on the tail end of that. So that's how I'm looking at 2024. Hope that helped, and I'll see you guys on the next one. Bye.